Welcome to this explainer. Let's just jump right in, because today we're dissecting a true make-or-break moment for gold, specifically the XAU/USD pair. Right now, we're standing on the precipice of a major, and I mean absolutely major, directional move driven by the July 10, 2026 U.S. Consumer Price Index release. Using our macro to micro framework, we're going to cut through all that market noise and break down exactly how this CPI catalyst could completely rewrite the market structure. We'll start with the big picture macro drivers and drill all the way down to precise, actionable chart levels.
Now, to figure out where gold is headed, we really have to look at what just hit the tape. 57,000. That's it. That's the spectacularly weak U.S. non-farm payroll jobs number for June. The market was expecting 110,000 jobs, right? So this is a massive, massive miss. It's actually the weakest reading we've seen since February. And to make matters worse, the previous months were revised down by another 74,000 jobs. This colossal data failure basically shattered that resilient labor market narrative the Fed was clinging to. And for gold? Well, this weakness is literally the fundamental oxygen fueling its current rally. It completely tanked the odds of a September rate hike, which sent treasury yields in the dollar lower, making zero-yield assets like gold look incredibly attractive.
Okay, let's dive into this tug-of-war happening in the market right now. On one side, you've got that fundamental oxygen we were just talking about, the big NFP miss and those plunging rate hike odds. That's pure, unadulterated bullish fuel for gold. But on the flip side, we have fading geopolitics. For months, ongoing conflict was baking a massive war premium into both gold and oil prices. But recently, with commercial shipping lanes in the Strait of Hormuz reopening and diplomatic talks actually making some progress, that geopolitical fear is just draining right out of the market. Plus, lower oil prices naturally mean lower inflation pressure. By contrasting these two forces, we can strip away the geopolitical noise and focus entirely on the pure macro mechanics driving gold's next big move.
Now, shifting gears from that macro engine, there's actually a hidden danger lurking just beneath the market's surface right now. We call this setup the institutional slingshot. See, while retail traders might be reacting to today's breaking news, massive hedge funds, they position themselves entirely around long-term macro narratives. The real danger hits when every single one of those institutional players crowds onto the exact same side of a trade. It creates a ridiculously unstable environment.
And this brilliantly illustrates exactly what we're talking about. Look at this latest commitment of traders data. It shows what happens when the smart money turns into a herd. Before things got heated geopolitically earlier this year, speculators were actually short the dollar by about $20 billion. And now, they have aggressively flipped into a $34.5 billion net long position. I mean, guys, that is a 7-year high. Leverage players have totally bought into this higher-for-longer interest rate narrative, piling into the dollar and ditching commodities. It's an incredibly and frankly dangerously crowded trade right now.
So, what does this all actually mean? What exactly is an institutional slingshot? Basically, it's a sharp, explosive counter-trend price move that triggers when a super-crowded speculative position is forced to unwind aggressively. Picture those $34.5 billion in long positions like a tightly coiled spring. These trend-following funds use really tight stop losses. So, if the US dollar suddenly drops, say because of a soft inflation reading, every single one of these funds is going to scramble for the exact same exit at the exact same time. They'll be forced to sell, driving the dollar even lower. And since gold is priced in dollars and moves inverse to it, this panicked unwinding creates a slingshot effect, rocketing gold prices higher in a matter of minutes.
Let's move over to the charts and see how this builds seamlessly into our precise, institutional-grade MT5 technical blueprint. Understanding the macro setup and the smart money positioning gives us our bias, sure, but knowing the exact levels where we need to execute, that's what separates the pros from everyone else.
Now, what's really interesting about this slide is that it highlights the absolute, undisputed line in the sand for gold right now, the Holy Grail. Over on the daily time frame, the 200-day exponential moving average is sitting dead on at $4,380. Gold has been stuck in this broad correction, just bouncing around inside a falling wedge pattern, and this 4,380 level is the absolute ceiling of that correction. If buyers can step up and decisively reclaim that daily EMA 200, it tells us the correction is officially over and the primary long-term bull trend is fully back on. But anything below this, technically gold is still just seeing a relief rally within a wider downtrend. But listen, before gold can even think about testing that holy grail at 4,380, it has to survive the immediate battlefield. Right now, that's the $4,200 psychological pivot. This zone is a complete technical minefield. It's where a descending trend line, which has basically capped every rally for weeks, perfectly crashes into a wall of heavy overhead supply. It's a massive liquidity pool. You can bet your bottom dollar institutional sellers will fiercely defend this 4,200 area to take profits from the recent run-up. However, if buyers can absorb that pressure and punch right through it, the runway clears out significantly for a major leg higher.
So, the crucial point is, how do we actually trade this volatility? Well, here is your map for the week, the highly actionable Trade with Zaman execution matrix. We are only looking for an institutional buy trigger if we get a confirmed, sustained break above that 4,200 battlefield we just talked about. On the flip side, if the rally completely fails and sellers take the wheel, our institutional sell trigger activates below 41.44. Now, if we just get a standard run-of-the-mill market pullback, keep your eyes absolutely glued to 41.42. That is our triple confluence retest zone, a prime area of structural support where we'd expect smart money buyers to step right back in and defend the trend.
Now, all these technical levels are basically just sitting there waiting for a spark. You've got to treat this like a ticking clock walking right up to the final catalyst. 3 days out, we watched the July 7 ADP jobs report for early labor clues. 2 days out, we picked apart the July 8 FOMC minutes to get a read on the Fed's internal debates regarding rate hikes. But all of that, just the appetizer. 0 hour is the July 10, 2026 CPI release. This inflation print is the undeniable main event catalyst that's going to dictate the Fed's next move and violently activate our technical blueprint.
Which brings us to the multi-billion-dollar question you need to keep asking yourself as you watch the charts this week. Will this make or break CPI trigger the institutional slingshot? Just picture the chain reaction here, guys. If consumer prices come in softer than expected, proving that inflation is actually cooling down, the market will instantly price out any future Fed rate hikes. The dollar plunges, which instantly sparks sheer panic among those crowded $34.5 billion long positions. Their forced, frantic unwinding becomes the slingshot, rocketing gold straight through our $4,200 buy level on the TZ matrix and putting us on a direct collision course with the 4,380 Holy Grail.
It's an absolutely explosive setup, flawlessly bridging macro data with pinpoint technical execution. Knowing the why behind these market moves gives you such a massive edge over people who are just trading blindly off blinking lights on a screen. The trap is completely set and the trigger is loaded. So, if inflation cools on July 10th, are you positioned to ride the slingshot, or are you going to get caught in the institutional unwinding? For more analysis and fresh updates, stay connected with Shah Zaman.